Hey traders, welcome back to another trades review video. So again, every time before we start a trades review, I always like to remind this: the purpose of us doing this series, for us to review your journal, is not to criticize you, it's not for all of you to judge or whatsoever on someone else's performance. Is to actually learn from each other, learn from each other's mistake, strength, and yeah, generally just see how can we improve together. So first trade was, this was on late February to March. Obviously this trader hasn't completed his journal. I don't think he's taking so little trade, but yeah. So let's have a look. The first trade was pound yen. So it was pound yen short, TPF entry. Okay, solid. So loss, it was a loss. 2 minute, I think he entered within 2 minutes he got stopped out. I think that's what it means. Then risk 2%. So just try to ignore the risk because everyone has different risk appetite, but obviously the risk was still a little higher on this side. See, 5% risk. So let's have a look. So wrong thesis. Okay, so the first thing we cannot see here is what a colorful chart. I always like to say this. If you wanna be able to read things more clearly, try to make sure you have less sketches on your chart. All right, the more sketch or drawings or lines you have on your chart, it will likely to cloud your ability to make decision quick. And obviously I can say, apart from volume, everything else here are just this session, right? Just basically the session you see here: Asian, London, New York, Asian, London, New York, here as well. You might as well just remove that because I don't think it's really helping anything. You can just manually mark out the Asian high, Asian low. You can do it yourself. And yeah, so the first trade was actually taken on, you see, it's 26th of January, so should be this one. All right, so it was a nice TPF entry, but I would like to remind all of you this. You see, up until here, market was still on a bearish trend because we have that faked out above that. I assuming it was around 190.82 intermediate structure, broke under the structure. The best entry was actually there. He got in the second entry here, should be based on limit order because he gets stopped out within 2 minutes. I believe it was because he was still looking at the TPF. But sometimes if you see price breaking under a structure like this, especially we're on a massive trend, so I want all of you to imagine this: pound yen for the past many weeks or many months, we've been on a massive bull run, all right, massive uptrend. So when price form a breakout under this structure, if it was real, if the structure was clean, if sellers are in control, it should continue to run. The fact that we just faked out the area, you see that how we break under this area, and we just sort of immediately reverse back up. That was actually an unhealthy signal. So from that, I'll tell all of you, it wasn't a very smart choice to actually go short there, because price have already recovered strongly after this sell-off. Massive recovery, completely pushed to the upside. So from here, all of you can actually see it wasn't a very smart decision to go short like that, especially on a limit order, because market recovered strong, completely pushed to the upside, moving average pointing upwards as well. So it wasn't a bad trade, but it's just a lack of understanding of who's in control and the market context. You can see took an aggressive short. He also admitted that it was an aggressive short. Seeing JPYX approach key support level, it was actually a resistance level, not a support. I think it was a wrong writing here. So quick entry on GJNC. Price were to fail, forming high low, I would manually close the trade. Okay, so he was using the JPYX to actually guide his idea as well. But again, JPYX pushed lower. I think he was expecting JPYX to rally. It wasn't very clear from his journal, but in fact JPYX begin to dump on that specific London session. That's what's affecting pound yen to actually rally as well. So again, it wasn't a bad trade. Again, it was a solid textbook style TPF. It's just that there's a lack of understanding of who's in control. A much better time to actually trade a TPF is actually seeing it's actually the first leg. You see here we have the fake out, dropped, that TPF entry dropped, although it didn't quite make it to the high, but the first leg are always the prettiest. You see here we have some nice push, fake out, dropped, first leg, sell. See that? So we go into the second position. So again, it's not a bad trade, it's just a lack of understanding. So Aussie dollar, it was a long, it was a loss pullback trade. Wrong thesis, you state that. So okay, he took a long position. So again, it was should be a limit order as well. It wasn't a bad trade. Again, it's just a lack of flexibility of understanding of who's in control. You see, when you see market sold off so aggressively and you just have a limit order there, normally it's just not a very wise decision. You see, took a trade at the key support level, not a high quality setup. He knew that it's not a high quality setup in general, could have been avoided, especially seeing price tested level repeatedly. Was a bit of an itchy hand trade. Again, overtrade, because if let's say if you look at the context here, I can't really see the bigger picture. I will suggest this trader please capture multiple time frames. If you just capture on the 15-minute, we can't see anything. Even if yourself, let's say 1 to 2 months later, when you want to come back and review your trade, review your performance of the year, of the month, you can't really tell what's happened. You have to actually manually look at this trade and go back to track on your trading view and see what happened after you close the trade. Have the habit of taking multiple time frame screenshot, especially on the 4 hour, the 1 hour, the 15-minute, just all different time frames, so you get the data. So next time when you look back into this trade, you can just refer back to your Notion. You don't have to flip to the trading view chart and just try to track everything manually. It's a waste of time as well. So 15 minutes is not enough, just not enough evidence to tell what's actually happening. So what I can say is the overall thing, the overtrend was fairly bearish on the 15-minute. I don't know what's happening on the 1 hour, but on the 15-minute it was bearish and price actually squeezed lower. Moving average was pointing downwards as well. You took a limit order long here. It wasn't a very wise decision. So third position was pound yen. Again, is a break and retest, breaking out key level. It was a loss. So let's have a look at this. And I would like to highlight all of you, tell all of you this. You see, it was a winning trade on March of 6. Then we have a March of 8 short position, all based on our trade call. You see, all the winning trade was actually based on the trade call. It's quite funny that you see. 1st of March, he had a winning trade based on trade call. Then 6th of March and 8th of March, he also had 2 winning trades, 1R, 2R, all based on trade call. So you really have to learn how to be able to identify your own setup as well. You see here, short, pound yen, key level break and retest, loss 2%. Rectified by larger stop loss. Don't really understand what does it mean, but again, let me see. I think the position, that's why when you do your journal, just make sure you do it properly, because from here I can't really see anything. See that? I can barely see there's a position here. Just unclear. You should have just again captured more screenshot. I'm not sure if you prefer to work on I assume this is an iPad, or do you just not prefer to do it on your computer? So have the habit of doing things on your computer, because it's just more easy to deal with, right? It's just a lot more convenient, right? iPad or phone, I think it's on an iPad. I'm not sure, it looks a little bit small, the resolution as well. If you look at this one, I can't really tell what happened. You only capture a 30-minute chart. Why don't you capture multiple time frames? The 1 hour, the 4 hour, where's the 15-minute? Why did you just capture the 30-minute instead of the 15-minute? So there's a bit of inconsistency here as well. If you go back to the previous chart on this one, the second one, Aussie dollar, you captured this on 15 minutes, but then why on this one did you capture it on 30 minutes? So you have a conflict here, you have a confusion here, it's inconsistent. So you need to make sure you journal it in a way that is really consistent, so you can track it consistently as well. So I can't really see what's happening here, but what I can say is I don't really understand why did you have the structure here. It was so minor as well. The only thing I can see is we have a resistance here, and we also have sort of an intermediate structure here. I'm not sure why is it here, but it's just not something that we teach in our community as well. It's not even related to any of our strategy. Maybe you were trying to trade a break and retest here. That's the only reason I can possibly think of. But you haven't seen the break, then you enter the position. See here, I think it was a loss. Yeah, it was a loss. If you look at this one, from what I can see from the chart, you were trying to trade a break and retest of this area, but price haven't break. You see that price was defending the zone that you draw here, and it pumped up before it start dumping. So why did you enter it there? And again, your stop loss was way too tight. How many pips are we looking at? Your entry was 190.681 and your stop loss was 190.75. Above these two are the entry and the stop loss of these positions, the first one. See that pound yen? So it's not related. I'm not sure why you have such a tight stops on pound yen, because on pound yen, on majority of the broker, just the spread itself is already beyond 1.5 to 2 pips. All right, for majority of the broker, the spreads on pound yen will be above 1 to 1.5 pip. So if you have a 6.9 pip stop loss, you're actually having only a 4 to 5 pip stop loss. So again, not something that we teach, not something that I teach, and it's definitely not the right thing to do. So for this trader, if you're watching this review, please make sure you change this habit. A good trader will never try to squeeze the stops until like 4 to 5 pip to 6 pip just to make quick money, right? The mindset of I want to have such a tight stops, you're basically being stubborn and just being denial and say, my ego is telling me it's going to drop here right now, this moment. That's why I always tell all of you, don't have such a crazy tight stops, because if you do that, very high chance you are not really doing what you're supposed to be doing. Sticking to the structure, sticking to a proper stop loss level, because like this one, you're placing a stop loss out of nowhere, and this structure is definitely not important as well. All right, if you have, there's only one thing I can see here is just the resistance. Yeah, the resistance here. So I'm not sure why you do it that way, but what I can really tell is you really should have improved on that one. So stop loss, don't make it so tight. You are just, it could be a little bit too egoistic, right? So dollar yen break even trade. So right now, because of that position, it forces me to actually spot your stop loss placement. All right, so this one's fairly okay. So I think it was 15 pip stop loss. Sorry, it's a little bit laggy here. So 15 pip stop loss, 716, x61 about 14.5 pip stop, pretty decent. And I'm not sure again, why did you close the trade for break even? Actually, I'm not sure why. And again, just one chart here, I can't possibly review your journal if you only show me one 30-minute chart. I can't see anything. I can't even tell you what's happening on the high time frame. So please, when you're looking to journal your trade, do it properly. All right, journaling is a very professional thing. It's a very holy thing as a trader, because if you don't do it properly, you can't improve. So if you look at this one, you break even the trade. Let's look at your reasoning. Took a short at the 150.71 level, seeing that multiple rejections, failed to notice that price formed a double top at 150.8. Could have taken the entry at the level instead. Yes, the answer is very, very true, because if you look at the exact reaction here, there's no really any key level here. And please, I want all of you to remember today, if you want absolute clarity when you trade, please have a habit of removing all these distractions, right? When it's over, just remove it, all right? Don't leave it on the chart. It's very messy. It's very untidy. It would certainly never help with your analysis. So please remove them, because it's not helping anything. Why do you keep them? Like the volume as well. If you're not looking at the volume, if you're not using the indicator, why do you keep it on your chart? Remove it. The session as well. If you're not if you're not using your setups, aligning with the session break or anything, Asian high, Asian low, London high, London low, whatever, why do you keep it on your chart? It's just messy. Just remove it. Just remove the indicator. It's not helping with your analysis. So again, if you look at the chart here, dollar yen short, it was a pretty good setup, because you can see here we have 1, 2, 3, 4 rejections here. We have a mini fake out on this one. We just completely collapsed. That's a squeeze. Nice rollover. You could have just held the trade, because it could have been a winner. And there's another retest here. See that break and retest? I'm not sure if you entered the position, but you should have just taken another. You see, price have proven you correct by selling off from 150.70 all the way down to 149.72. So that was about 100 pips drop. So when it pulls back, testing the BNR, why don't you take a short? Pretty simple. So pound oil, it was a winning trade. I know that was the setup that we call as well. I remember about 1 or 2 weeks ago, we traded a lot on pound dollar, and we were able to capture lots of opportunities to the upside. But I'm not sure why it's only 1R, because from here I can see it was more than that. I'm not sure why it's 1R. It looks like a 2 to 3R trade. Let me see. You see, that's one of the things I always reminded all of you. When you have a position that goes into your favor, I don't like you all to do such thing as closing half the trade at 2R and then move stops to break even. There's no logical sense. If you close half your position at 2R, you're technically only taking 1R profit. So when it comes back, hit your break even, do you think it's logical? Honestly, just to ask all of you again, when a position goes into 2 to 3R, if it's really a good setup, it wouldn't come back, right? If it's really a good setup, it wouldn't come back. Honestly speaking, unless it's more of a range trade, then obviously we try to not move our stops. But if it's a reversal trade like this, especially a TPF, why do you have to move stops to break even like that? And from here I can see it's beyond 2R. It's not just 2R. At one point it was up about 2.5 to 3R. You should have just closed the position after seeing the reaction, and it's come back. You can always get back in. So again, because you see it's supposed to be a 2R trade, 2 or 2.5R trade, but because you move stops to break even, you scale at half the size, it's not actually doing any help, and in fact it's actually doing damage to your profit. You see, you only close for 1R. All right, moving stops to break even, closing half the size, is a lazy way, is a fearful way to manage a position. Pardon my word, but I do think it's true. All right, just being transparent with all of you. See, Euro Aussie key level rejection, probably long, MA too large to be rectified by a larger stop loss, as I can see here again. Okay, so for this trade, I actually understand why you're taking it, because overstructure was pointing bullish and you were trading the equal or rejection. So this is a good loss. All right, this is a good loss. So nothing much to talk about this. It's a pretty clean setup, but what I can say is that's pretty aggressive. When you see such an aggressive candle pushing into a support area, just don't enter based on that. You can always say, oh, I'll observe it a little bit longer. You see, when price come back up, you can get back onto a long here and write this up. It's a lot easier to trade. Don't see such a massive sell-off candle, then you just put on the limit order like that. Unless you're too confident on the setup, then that's a different case. But range trade, thesis wrong. Could it have been avoided after seeing the price test the resistance multiple times? Not really, but what I can say, the setup is still pretty good, solid, but that's just way too aggressive. Right, that's just way too aggressive. Dollar CAD break even, personal trade. Let me see. Not really sure where's the news event, but what I can say is it was a very clean setup. See that, just multiple rejections at the high, then you were anticipating some short-term pullback. It was a very clean setup. And yeah, I'm not sure why you moved stops to break even. Your reasoning was there was a news, so you decided to took half profits at 1R. Why took half profits at 1R? Why don't you just completely close your position at 1R? Because that's a major news. That's why I want all of you to always think about this. When you're dealing with uncertainty, have the habit of making quick decision. You're either going to close the trade, you're either going to hold the trade. Don't have the habit of, let me take half the size, let me take partial. I mean, why do you have to do that? Because if there's a major news event, if there's a lot of uncertain factor, just unpredictable in general, why do you want to gamble the news? Just close the trade. And again, the risk was very inconsistent. See that 5% risk, and then prior to that you have 2% risk, and suddenly you jump back to 5% risk. Then the next one you go into 1% risk. Then the next one you go to 5% risk. I personally, I do have a linear risk per trade system, which means I grade the quality of the setup and adjust my risk allocation accordingly. But you shouldn't have that big gap. You see, 1% versus 5%. That's like 5 times the risk. And how do you justify that? You don't have if you don't have a reason for that, you shouldn't do it. Again, if you want to have consistent performance, you can have a linear risk per trade system, which means you grade the setup and then you allocate a risk accordingly. This setup, if it's A+ quality, is 1.5% risk. If it's substandard, if it's not so high quality but it's worth the risk, maybe I risk 1%, maybe I risk 0.5%. The gap is still small, but from 1 to 5%, the gap is like positive, just plus minus 4% gap. That just no logical sense, right? So you could have just closed the trade. Again, have the habit of making quick decision. So you see, you only risked 1% on this one. It was again 1R. I believe you should be, you see again, took half the profits at 2R. Then you hit break even. Again, why do you choose to break even the trade? Why do you not just hold on to the trade, or you take full profits at the high? See that? I want all of you to please understand this basic common sense. There is no logical sense behind, if it goes to R, I take partial, move stops to break even. If you have that much urge to move stops to break even, you might as well don't trade the financial market, because you are saying that you want to risk free, right? If you want to risk free, don't take the risk, right? Trading is a business, therefore it has risk. Don't have the habit of move stops to break even. You can move stops to break even when price have broken the significant structure. Let's say right now price breaks the structure like this one, break above, come back. Of course you can move stops to break even because you have already a shift in obvious structure, and you have the clear, you just have a clear trend confirmed ahead. Then you can say, when price break above this area, I'll move stops to break even and let the remaining run. That's fine. But price haven't even breaking above the structure, and you just randomly say, I'm gonna take partial, I'm gonna move stops to break even. What's the logic behind it, right? So, okay. So just don't do that again. This particular trader is not a good habit at all. If you keep doing this, trust me, you will never make money. Why? Because you're always winning, losing, break even. On good trade, you break even too quick, then you run. And see this one, it could have been a 5R, 10R trade. If you manage and skill in accordingly, it could have been such a big runner, at least 5 to 8R, because your entry was perfect. Why do you do that? Why don't you just close it after seeing the failure? As it comes back, you take another entry back up, or when it breaks above this structure, come back for a retest. See that? We have a break and retest here. Then you get back in, full size. Right? So why? Right? But the past week have not been able to catch trades as price usually keep running higher. Current back tested data is on range and double top and bottom pattern, so we'll need to back test BNR to deduce which one is better. In this case BNR, but a couple of positions early in this week would have favored aggressive entry. Again, the past is the past. There's no point saying, oh, a couple of trade early this week that have done this, blah blah blah. The main thing is what the market is showing you right now. We don't trade the past tense, we trade the current condition. So there's no point looking at the past unless you're referring to the past data and start to analyze things, engage some sort of analysis. Otherwise, don't. It's all an excuse. To be honest, to be frank, pardon for language, but it's all excuses. All right, you didn't manage the position well. The fact you didn't manage it well, you didn't manage it well. There's no such thing as blah blah blah, because the past week the market was doing this, because I was doing this, doing that, that's why blah blah blah. Just a bad management. All right. The last one is Aussie yen. Again, that was the setup that we call, so pretty clean range trade, short at the resistance, price comes down, very solid. You close exactly at the time where I closed it as well, aligned with my personal back testing. I was comfortable to risk more, close up for 2 hours, and price was slowing down. News in a few hours. So clean trade, pretty good, nothing much to discuss about this. So just a quick summary of this trades review. What I can say is there are a few key points here. First thing, manage your risk, please. Risk allocation is so important. You can't have some trade you risk 2%, some risk 5%, some risk 1%. You can have a linear risk per trade system where you grade the quality of the setup, you adjust your risk accordingly, but not that much of a gap. You can't have such a massive gap and say, oh, this trade I'm going to risk 5%, this trade 1%. What if the 1% trade turns out to be really good? How many R do you need to make to overcome one of the loss? Let's say you risk 5% on the previous trade and you lost it. That's a negative 5%. And right now, if let's say this trade is going well, you only risk 1%, how can you possibly cover the cost? How can you possibly cover the loss? You need to make 5 times this trade. You need to have at least 5 R to cover just 1 R loss. So it's tough, right? You can have, again, you can adjust your risk accordingly, but it cannot have such a massive gap. It's bad. Second thing, clarity is consistency. Remove some of the unnecessary indicator on the chart and make it clear. Third thing, when you're doing your journaling, have a habit of capturing multiple time frame. Don't be lazy and just capture one time frame. Let me ask you, if I today were to sit in front of you and ask you, what's the after post trade price action, what's the bigger picture like? You can't even tell me because you only captured one time frame and you're using a tablet. I'm not sure if you don't have a computer, then that's my problem, but generally speaking, you need to just do it properly, right? Do it properly. This is just not so professional to do it on an iPad or phone at worst. Then the last thing would be, pattern is important, but you need to use it at the right context. Let's say today we're trading a TPF. Well, the market is just on a pro-trending condition like this one. If market is on a pro-trending condition, TPF, aggressive TPF entry like that would never work. You got stopped out on this trade within 2 minutes. 2 minutes. So you can imagine that. And the last point will be your stop loss distance. Before you actually follow my trade, I can see you actually have a pretty tight stops. Just like pounding in on this one. What's the stop loss distance? 7 pips, 6.9 pips. All right, 681750, 6.9 pips stop loss. What's the spread? What's the actual stop loss distance? The moment you enter the trade, you are already down like 25% of the trade. That's your drawdown. So that's pretty much it for the trades review on this one. I hope all of you also learned something new. And yeah, talk to you later. Bye bye.